There are 12 official definitions for R&D, yet there's zero agreement. The US government alone publishes at least a dozen distinct official definitions across agencies, accounting standards, taxing authorities, and then don't even consider the international bodies. Not one agrees with the others on what research ends and where development begins. Trillions of dollars flow through R&D budgets every year. Boards approve them. Investors evaluate them. Governments subsidize them. Analysts benchmark them. And yet the term at the center of it all has no settled definition. A company can gut its research investment without triggering a single alarm on its income statement. Researchers who gained rare access to confidential federal R&D found exactly this. When companies face financial pressure, they cut research while leaving development essentially untouched. And the combined number barely moves, and it sets off no flags on Wall Street. Every benchmark, every board conversation, every investment thesis built around the R&D line is built on sand. Innovation is ideas made real, requires both. Research is how you find the idea. Development is how you make it real. Strip out the research and you're not innovating. You're iterating on what already exists. Strip out the development and you're just experimenting. The problem is that nobody in the room knows which one they're actually funding, because the definition that would tell them does not exist. Someone needs to draw the line. This episode is about why nobody has, and the definition, I think, should replace the chaos. By the end, I'm going to put that definition in front of you, and I'm going to ask for you to push back on it. Do I get it right? Am I wrong? Are there things I'm not considering? I'm not asking you to agree. Tell me where the definition I'm going to propose breaks. So, how did we get here? 4 institutions took a run at defining R&D. Each one got it right for their own purposes. None of them got it right for our purposes as innovation leaders. First up, in June of 1963, OECD economists met at a villa in Viscati, Italy, south of Rome, and produced what became the international standard for measuring R&D across nations. Now in its 7th edition, the Viscati Manual divides R&D into 3 tiers: basic research, applied research, and experimental development. Basic research is theoretical work with no application in view. Applied research is original investigation toward a specific practical objective. Experimental development uses existing knowledge to produce new products or processes. To qualify, an activity must be novel, creative, uncertain in outcome, systematic, and transferable. Now, this standard is used by governments across roughly 75 countries. Solid for what it was designed to do: let nations compare R&D investment on consistent terms. What Viscati cannot tell you is whether a specific company's spending is creating competitive advantage. It counts the type of activity. It doesn't assess what that activity produces for the organization during the spending. A company can satisfy every Viscati criterion investigating something every competitor already knows. The knowledge is new to them. That's enough to qualify. Now, the accountants drew a different line for a different reason with a different consequence. The FSAB, the Financial Accounting Standards Board, back in October of '74, issued Statement Number 2, Accounting for Research and Development Costs, now codified as Topic 730. Every public company filing under U.S. GAAP accounting operates under it. The rule: all R&D cost expensed as incurred. Research, development, basic, applied, one line on the income statement. Their definition: research is a planned search aimed at discovery of new knowledge. Development is the translation of research findings into a plan or design for a new product. The rationale is explicit in the original standard. Future benefits from R&D are, in FSAB's language, at best uncertain. Expense everything immediately. The standard solved the problem it was asked to solve, which was accounting treatment. When to recognize the cost, not whether the costs were strategically sound. The consequence? Sustaining engineering, future maintenance, and incremental product updates all land on the same line as genuine exploratory research. Nobody looking at the income statement from the outside can see the difference. The number is technically accurate and analytically opaque. Abram Biloff, the late accounting professor at Burge College, put it plainly. Accounting statements are like bikinis. What they show is interesting, but what they conceal is significant. He was talking about financial reporting broadly. He could have been writing specifically about the R&D line. Researchers at Duke and London Business School spent years tracking corporate scientific output and found that it declined steadily across industries even as headline R&D spending kept rising. The combined number was hiding a substitution. Nobody on the outside could see it. Outside the United States, a different standard governs, and it creates a comparison problem most analysts never account for. IFRS, it's really built for international standards. It has a standard called IS 38 governs R&D, and its treatment differs from FASAB in one significant way. Research costs are always expensed, same as the US side, but development costs can be capitalized as an asset on the balance sheet once a company can demonstrate the technical feasibility, intend to complete, and ability to use or sell the result. The likely future economic benefit, adequate resources, and reliable cost measurement. At that point, you can expense the development. A European company that capitalizes its development phase carries those costs as an asset. Lower expenses in the period, higher total asset value. An identical U.S. company expensing everything under the U.S. rules takes the full hit immediately. R&D is never seen as an asset. Higher expenses, and it's actually lower assets. Same underlying investment, same dollars being spent in comparable financial pictures. Run the standard industry benchmark, which is R&D as a percentage of revenue, and you may conclude the R&D company is investing more aggressively. You may be comparing the same dollar invested under two different accounting regimes. Roughly 169 jurisdictions use IFRS. The United States does not. India uses an adapted version. Japan maintains its own standards. The benchmark the industry trusts most is meaningless for cross-border comparison, and almost nobody says so. So, the Internal Revenue Code adds another layer to this craziness. Section 174 governs the deductibility of what the U.S. tax authority calls research or experimental expenditures, and the definition is not the same as FSAB, under GAAP accounting, topic 730, nor any of the other international standards. A company's R&D for tax purposes and its R&D for financial reporting can cover different activities and produce different numbers. The Tax Cuts and the Job Acts of 2017 tighten this even further. Domestic R&D expenses that were previously deductible immediately now must be amortized over 5 years. International, over 15. The definition of what qualifies shifted when the timing rules changed. Within one country, one company, three definitional regimes apply simultaneously. Fiscati for any government reporting, FASAB for income statements, and Section 174 for taxes. A single dollar of R&D spending can be classified three different ways depending on who you're talking to. The real issue is there's four frameworks built by four institutions for four different purposes. Not one built for the question that actually matters. Is this investment creating new knowledge that gives us capability nobody else can easily replicate? The gap between them is where innovation decisions actually live. The National Science Foundation recognized this problem clearly enough that it publishes a separate annotated document just to catalog the competing definitions because they're too inconsistent to assume any two readers are using the same one. That gap is not an oversight. It's a structural consequence of four institutions doing their jobs well. The question practitioners, us as innovation leaders, need answered was nobody's institutional job. You've been in the room, the R&D numbers is on the slide. Your leadership is presenting it. Nobody asks what's inside it because the accounting standard doesn't require an answer. And the room has learned not to expect one. So it went unanswered until now. We need a better definition for R&D to represent innovation efforts. Research is work directed at creating new knowledge where the outcome is genuinely uncertain. The knowledge cannot be readily attained from existing sources versus development is the translation of that knowledge into products, services, or processes that meaningfully advance an organization's capabilities in ways competitors cannot easily replicate. Four elements define it. Let's dig in. This is what I am proposing to be the new definition. First, genuinely uncertain outcome. If you know what you're going to get before the work starts, it's engineering execution, not research. The uncertainty doesn't have to be total. Most applied research has a likely direction, but there has to be real doubt about whether the approach works and whether the knowledge emerges. Second, cannot be obtained from existing sources. This is the one nobody puts in writing. If the knowledge is already in literature, available from consulting engagement, or present in a competitor's published work, finding it again is not research. Generating new knowledge, capturing existing knowledge are different activities. Only one belongs here. This criteria alone would reclassify a significant part of what companies currently call R&D. Third, advances capability competitors cannot easily replicate. Development only qualifies when it translates research into something that genuinely moves the organization forward competitively. Sustaining engineering doesn't pass it. Feature parity doesn't do it. Competitive catch-up does not do it. All real work, none of it development under this definition. Fourth, agnostic to accounting jurisdiction. This definition doesn't tell you how to expense or capitalize anything. That's already governed by whatever standard applies. What it does is establish what genuinely belongs in each category, regardless of where the company files. That makes it usable across US and international companies without translation. Now there's a simpler way to put it. For any project in your R&D budget, ask two questions. First, are we creating new knowledge or executing against something we already know? If you're executing, it's not research. Second, does this translate into capabilities competitors cannot easily replicate? If not, it's not development either. It's product engineering. Valuable and necessary, but a different budget category completely, not R&D. So you have three buckets: research, development, product engineering. That taxonomy applied honestly across a typical portfolio would reclassify a significant share of what most companies are currently reporting as R&D. I'm not asking FSAB to rewrite Topic 730. What I am asking is that the people who actually make innovation decisions start applying a definition built for the question that you, I, they were trying to answer. If you run an R&D function, apply this definition to your current portfolio, not to change the accounting, to see what's actually in the category and what isn't. The gap between what your project calls R&D and what this definition called R&D will tell you something worth knowing. If you sit on a board, ask what portion of the R&D line is directed at new knowledge creation versus sustaining existing products. If no one in the room can answer, you are governing a number you do not understand. And if you think this definition is wrong, tell me. Give me feedback. Do you agree in the three categories? Research, development. Key on development is it going to create sustainable differentiation, or is it product engineering? Research, development, product engineering. Do I have it right? And if you think the definition is wrong, tell me. Push back, post a comment, drop me a note, let me know. And if you don't agree, don't just say you don't agree. Tell me where the line should be drawn differently. What element doesn't hold? What did I miss? What's not what am I missing? This is the actual point of this episode. Definitions become standards when enough serious people apply them consistently and make the case until the institutions catch up. The four frameworks we've inherited were each built by an institution serving its own purpose. This one is built for people making the tough innovation decisions. The most consequential line in any company's budget is the one separating what builds the future from what protects the present. Nobody draws it clearly. It's past time someone did. The idea was never the hard part. It never is. Making the call. Make the call today. If this episode shifted something for you, subscribe wherever you listen to this podcast. If you're on YouTube, hit that subscribe and click that bell so you don't miss the next episode. And if you want to go deeper, every Monday, Studio Notes, it's free. You just hop over to philmckinney.com and click in. Now, I'm going to add a little side comment here at the end of the episode. One of the common questions I get from you, the viewers, the listeners of the show, is around tools and that I use in my innovation practice here in my innovation studio. So periodically at the end of an episode, I'm going to go through and share just one tool. Now, some of them may sound inconsequential. Some of them may be more significant. I think I've already introduced my Bamboo 3D printer. I use that thing is going nonstop. In fact, it's paused right now so I can record this episode. But one of the things that I'm a nut for is pens and pencils. I'm constantly writing notes, etc. And one of the things I recently procured, it's very hard to procure. I will warn you now. They're very hard to get your hands on. It's a Uniball Zinto signature. It is a pen that I have absolutely fallen in love with. It's an all metal, got a little magnetic clip on, got a cap process on it. They've developed custom ink for this thing. This thing is the Ferrari of pens. Now, retail, if you could even find one retail, they sell out within minutes whenever restocking happens. Can run you about $25. If you go over to Amazon or you go over to any of the retail sites, you could be paying $50, $75, $100 for this pen. But let me tell you, For me, for doing my journaling and for me working on my ideas, this is the pen. I'll put a link in the show notes so you can check it out. But if you're interested in my tools and that, let me know and I'll do more of these to give you a little bit of insights. I just picked up and procured a set of very, very high-end sketching pencils. I've also created, some people have been sending me some new journals and new notebooks, and I'll be discussing those also in the future. So with that, remember, R&D, development, product engineering. Think about your spend in those three categories. Dig in, follow the numbers within your organization, and I think you'll be surprised. They will tell you a lot. Now, until next week, get out there, make those hard decisions. The ideas aren't hard. The decisions are the tough part. Make the call. And we'll talk to you soon. Bye-bye.